What if I told you the Federal Reserve has already seen what's coming in 2026? And they're not warning you. They're positioning themselves, not through press releases, not through speeches, through actions so quiet, so technical, that unless you know exactly where to look, you'd never notice. But the people who do notice, the people who understand what these moves actually mean, they're already making decisions, big ones, irreversible ones, and the window to understand what they know is closing faster than most realize. Because this isn't about a correction. It's not about a recession. What the Federal Reserve is preparing for is a structural breakdown in the very system they were designed to protect. And the reason they're preparing quietly is because the moment the public understands what they're seeing, the event they're preparing for accelerates. Let me show you what's happening. In late 2024, the Federal Reserve began expanding what's called the standing repo facility. Most people have never heard of it. It's a lending mechanism designed to inject liquidity into the financial system during stress. Think of it as the emergency valve. The fact that they're expanding it now, in a period the media still calls stable, should tell you something. But here's the part that matters. They didn't just expand capacity. They changed the collateral requirements. They broadened what they'll accept in exchange for cash. That's not a precaution. That's preparation for a moment when normal collateral, treasuries, high-grade bonds, stops being enough. When firms are so desperate for liquidity that they'll bring anything to the window. And the Fed knows that moment is coming. Now ask yourself, why would the Federal Reserve expand emergency liquidity infrastructure in 2024 and 2025 if they believed the economy was sound? Why would they build a bigger lifeboat unless they'd already done the math on how many people are about to need one? The answer is in the debt. U.S. federal debt is now over $36 trillion. But the number itself isn't the problem. Debt can grow. What cannot grow forever is the cost of servicing that debt. In 2020, the average interest rate on U.S. debt was under 2%. Today, it's over 3% and climbing. That difference, just 1 or 2 percentage points, adds hundreds of billions of dollars in annual interest payments. We are now spending more on interest than we spend on defense, more than we spend on Medicaid. And every time the Fed holds rates higher for longer, that number grows. It's not a political problem, it's math. And math doesn't negotiate. But here's where it gets worse. The Treasury has to roll over that debt. Every year, trillions of dollars in bonds mature and need to be refinanced. In a low-rate environment, that's manageable. But in a high-rate environment, especially one where foreign buyers are stepping back, it becomes a trap. Because the Treasury has to keep issuing bonds to pay for the interest on old bonds. It's a compounding spiral. And the Fed knows that if confidence in that process cracks, if buyers hesitate even for a moment, the entire funding mechanism of the U.S. government seizes. That's what they're preparing for. Now let's talk about what's happening in the banking system. Because while the headlines have moved on, the fractures from 2023 never healed. Silicon Valley Bank, Signature, First Republic. Those weren't isolated failures. They were symptoms of a deeper structural problem, duration mismatch. Banks borrowed short and lent long. When rates spiked, the value of their long-term assets collapsed while their short-term liabilities stayed the same. The result? Insolvency. And the only reason it didn't cascade into a full systemic collapse was because the Fed opened another emergency facility, the Bank Term Funding Program, to backstop the entire sector. They paused the crisis. They didn't solve it. And in March 2024, that program expired. But the risk didn't. Hundreds of regional banks are still sitting on unrealized losses in their bond portfolios, losses that don't show up on their balance sheets until they're forced to sell. And the moment depositors get nervous and start moving money, those banks have to sell, which locks in the loss, which triggers the crisis. The Fed knows this. They've run the stress tests. They've seen the scenarios, and the reason they are expanding liquidity tools now is because they know the next wave won't be 3 banks. It'll be 30. And here's the psychological trigger that sets it off. Perception of instability. It doesn't take a real collapse to start a bank run. It just takes fear, a headline, a tweet, a rumor that one major institution is in trouble. Because in a fractional reserve system, no bank has enough cash to give every depositor their money back at the same time. The system only works if people believe it works. The moment that belief cracks, the system freezes. And in 2026, the number of potential triggers is higher than it's been in decades. Let me give you one most people aren't watching: commercial real estate. Since the pandemic, office vacancy rates in major U.S. cities have stayed above 20%. In some cities, it's over 30%. That's not a temporary dip. That's structural. Remote work didn't go away. Companies downsized their footprints. Leases expired and weren't renewed. And the buildings those leases were supporting? They were financed with commercial real estate loans, billions of dollars in loans that are now underwater. The buildings aren't worth what the loans say they're worth. And those loans sit on the balance sheets of mid-sized and regional banks, not the giants, the smaller ones. The ones without the political pull to get bailed out quietly. Starting in late 2025 and accelerating into 2026, a massive wave of these loans comes due. they have to be refinanced. But how do you refinance a loan on a building that's half empty in a high rate environment with a bank that's already underwater on its bond portfolio? You don't. The loan defaults, the bank takes the loss. And if enough of these defaults happen at once, you get contagion. One bank's failure spooks depositors at another, liquidity dries up, the Fed steps in, but the market has already moved. Now, layer on top of that the global dimension, because US debt isn't just a domestic issue, it's the foundation of the global financial system. Treasuries are the collateral. They're the reserve asset. They're what every other market prices off of. And for the first time in generations, the largest foreign holders of US debt, China, Japan, are reducing their positions. Not dramatically, not loudly, but steadily. China's treasury holdings have dropped by hundreds of billions over the past few years. Japan, facing its own fiscal crisis, has slowed its purchases. And into that gap, the Fed itself has had to step in as a buyer, not because they want to, because they have to. Because if they don't, yields spike. And if yields spike, the cost of everything, mortgages, corporate debt, government funding, explodes. This is the trap. The Fed can't raise rates too high or they break the Treasury market, but they can't lower rates too fast or inflation reignites. They're stuck. And the longer they stay stuck, the more obvious it becomes that there's no clean exit. Which brings us back to 2026. The Federal Reserve doesn't publicly forecast crises, they manage perception. But their actions tell you what their models show. And right now, their actions show preparation for a liquidity event severe enough that normal tools won't be enough. They're expanding repo facilities. They're stress testing for scenarios worse than 2008. They're coordinating with other central banks on currency swap lines, which is what you do when you expect foreign dollar funding markets to freeze. These aren't the moves of an institution confident in stability. These are the moves of an institution that's seen the simulation and knows how it ends. And here's the part that should unsettle you. The Fed isn't trying to stop the event. They're trying to manage it, because at a certain point, the math becomes unavoidable. You can't have infinite debt, rising rates, and a fractured banking system without something breaking. Physics doesn't allow it. The question was never if, it was when. And everything the Fed is doing right now suggests their answer is 2026. Now let's talk about what this looks like when it unfolds. Because the important thing to understand is that modern financial crises don't announce themselves. They don't start with a crash, they start with a freeze, liquidity disappears, credit markets seize, overnight lending rates spike. And by the time the headlines catch up, the professionals have already moved. The public sees the crisis. The institutions saw it weeks earlier. And the Fed? They saw it months earlier. That's the gap you're trying to close right now. The gap between what's being prepared for and what's being reported. When the liquidity event begins, it will probably start in a place most people aren't watching. Not stocks, not crypto. Somewhere deep in the plumbing. The repo market, the commercial paper market, a spike in SOFR, a failed Treasury auction. Something technical that only shows up on Bloomberg terminals. But that technical failure will cascade, because every market is connected. When one seizes, the others follow. Margin calls go out. Forced selling begins. Volatility spikes. And the Fed, who's been preparing for exactly this, steps in with the tools they've been quietly building. They flood the system with liquidity, they backstop the banks, they expand their balance sheet again, and the headlines call it a rescue. But it's not. It's containment. Because the underlying problem, the debt, the rates, the structure, doesn't go away. It just gets papered over again. And here's the psychological warfare embedded in all of this. The Fed will use fear to maintain control. They'll allow enough volatility to scare people into compliance, enough chaos to justify intervention, but not so much that confidence collapses entirely. It's a managed burn. And the reason it works is because most people don't understand the difference between a market crisis and a systemic crisis. A market crisis is prices going down. A systemic crisis is the system itself breaking. The Fed can survive a market crisis. They've done it before. What they're preparing for in 2026 is the edge of something systemic. A moment where the tools that worked in 2008 and 2020 might not be enough. And if those tools fail, the fallback is something nobody wants to say out loud. Monetization. The Fed directly funding the Treasury, printing to cover the gap. And once that line is crossed, once the market understands that the Fed will print rather than allow default, the value of every dollar in the system gets repriced. This is not speculation. This is the logical endpoint of the path we're on. You cannot run deficits of $2 trillion a year, finance them with debt, and raise the cost of that debt without reaching a breaking point. And the Federal Reserve knows this. They've known it for years. The difference now is that the timeline has compressed. The variables have aligned. And 2026 is when the math runs out of room. So what does this mean for you? It means the window to understand what's happening is not wide. It means the difference between being early and being late is not months, it's weeks, maybe days. It means that when the event begins, the public explanation will lag behind the reality. The news will tell you it's contained, the officials will tell you it's temporary. But the people who understand the structure, the ones who've been watching the Fed's preparations, they'll already know. They'll know that what's being called a disruption is actually a transition from the system we thought we had to the system we're about to get. And here's the final thing to understand. The Federal Reserve is not preparing to fail. They're preparing to survive, to maintain their role, to ensure that when the dust settles, they're still the ones controlling the levers. Because central banks don't die in crises. They expand, they gain power, well, no, they become more essential. And every emergency measure they're building right now, every facility, every tool, every justification, those don't go away when the crisis ends. They become permanent. That's the pattern. That's the history. And 2026 is when that pattern repeats on a scale we haven't seen before. The Federal Reserve is not warning you because warning you would accelerate the very event they're trying to manage. So they prepare quietly. They move in the shadows. They expand the infrastructure of intervention while the public is told everything is fine. But their actions are louder than their words. And if you know how to read them, the message is clear. The math is already locked in. So let me ask you this. If the Federal Reserve is positioning for a financial event in 2026, what are you positioning for? Drop your answer in the comments. I want to know what you think happens when the liquidity finally runs out. And if this connected dots you hadn't seen before, you know what to do. This isn't the kind of information that stays visible for long. Share it, save it, and stay ahead of what's coming. Because the people who see it first are the only ones who get to decide what happens next.